So here's the first hour's dealing range, as the title should be showing in the description portion. So first hour's dealing range. Now we can take, watch this low, okay? Watch this. There's a couple ways you can do it. You can do this, drag it down to that little dotted line, lays right on the low, like that. And that'll give you a projection of where price may go, okay? Now, let me ask you a question. When I was talking in I believe it was the first Trader Roundup podcast that was after my live stream yesterday, if I'm not mistaken. If I'm incorrect, I apologize, but I know I said it yesterday, at least in one of them, but I want to believe it was the first one. I talked about how, or maybe it was my live stream. It may have been my live stream, but I was talking about how, it was definitely my live stream, because I was referring to how I used the setup in the NASDAQ or the micro NASDAQ. And I went short during the Wednesday live stream. I said at the closing portions of that, I said, okay, it's going to go lower. Just study this. And I used relative equal lows. And I didn't use the lower low. Because of the climate that we're in, it's not likely to break the range. Okay. So if we know that that's likely to happen, and that, like, say this is the perfect scenario. This is two ranges. It's the first hour's range and then the projection of that down. Okay. So this is like a standard deviation of the range established in the first hour, then projected lower. All right. Think like how I teach flout and the Asian range projections, all those types of things that I taught in the 2017 portion of the paid mentorship lectures that's on my YouTube for free. Stop paying for it. These people are rooking you. I give it to you for free. You're out here looking for something you can pay for. So what happens if this is the perfect scenario? You anticipate this as the low that could happen if it's perfect, right? Did it get there? Nope. Didn't happen. Does it mean it's flawed? No. But here's what you can do. You can take this range and say, okay, I want to be trading with the highest degree of probability, but in the same direction. And you think this is the range that it could trade down to. Okay, what I'm doing is I'm anchoring to the visual low of that rectangle. Okay. Now, because I have that on, I can do this. I'm going to borrow the 75 level. So 75% of the range that could be delivered if it's 100% run, which would be a full breakdown below these lows to get down here, which is one full replication or standard deviation of the first hour's dealing range. If it can get that far, that's a perfect world. But are we trading in perfect market conditions and climate right now? Absolutely not. It's a whole lot of tomfoolery. So what you could do as a suggestion, when you know that you're likely in a scenario where it could probably be unfulfilled for the day that you're trading, it could get there, but you don't want to hold on to overnight risk. You don't want to hold on to over weekend risk where Sunday's gap opening could be actually against you. By placing the 75, okay, we'll do 25 here. So 25 would be the lower portion because I drew the fib from the high down to low. So there's your lower order. Okay. So this portion here, anywhere in here, is an ideal area to take a close and be content. Or as soon as we get into this, be aggressive about trailing your stop loss. Okay. So what that does is it helps you manage any open position and not allow it to come back and take a lion's portion of the run away from you. Okay. So like, for instance, when we had this drop down in here, rallied up, look where the bodies are stopping. Now I'm going to show you something in a minute, how all this was reacting using the information based on the first hour's dealing range. Just let me see this boring part first. But when it starts to drop off here, you can then trail your stop loss here. And as it breaks lower, 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 you're going to trail your stop loss all through here. Every single time it creates a little short-term swing low, or every 3 candles. Every 3 candles. Every time it makes a new set of 3 candles, trail the stop loss down. You don't need swing highs when you do that. 1, 2, 3. Okay. your stop loss would be above the last 3 candles high. And then when it creates another 3 candles, 1, 2, 3. Okay. When it breaks lower, your stop loss would be dropped down just above this high. Just keep a running range that's dynamic on a 1 minute chart or whatever time frame you're using. And what that does is it allows you to strangle the unrealized profit. And then if you get stopped out, you're done. Just walk away. And that would happen where you get stopped out. It would be somewhere in this area here, probably on that candlestick, or if not that one. So you wouldn't have got out at the exact low because you're trying to get to this low as a perfect scenario, but you're getting stopped out in the direction of the run continuously moving, but not giving back the majority of the run. Okay. Sometimes when you see me trading and you'll see me do partials after there's been a short-term little turn and it's not me getting stopped out, I'm just doing a partial and it looks like I'm taking a partial on an up-close candle. I'm using the logic of watching that rule I just gave you, which is 3 candles, the highest high in those last 3 candles. That's where your stop loss would be. You're not doing that in every trade. You're doing that when there's a condition like this where the probabilities of it, jerking and changing gears and going against you real quick and not getting to your target, it helps you frame a logic of trailing the stop loss tight and being okay and happy if it stops you out and not worrying about it. Otherwise, you would leave your stop loss up here and let it try to go to it. But it's not in those kind of conditions right now. We have a lot of tomfoolery, a lot of unrealized ranges or targets because there's a failure to launch trying to get to these objectives because it's very difficult market conditions. And first hour's range here to there. And we'll drag it down so it's laying over top of it like that. So what I did was I laid that 50% level right there at that low. Now I'm going to go into the fib settings. I'm going to add all of the octants. Watch what happens. Okay. So here is the first hour's dealing range. Okay. And that low is the low of it. That's that little false break below it. And then back into the range we went. Look at the retracement here. It can get to the first percent of fair value gap, but it can get to the upper octant. Oh, wow. Right. So it drops down. We use the high of this candlestick here. It's using this quadrant, upper quadrant there. Sells off, works around in here, back into the gap. Manipulation. So when we see things run that's not laying on top of an octant or a quadrant level, because that's the basis of a key level. If you're seeing things happen in price action and it runs where it doesn't make sense and it's not on or trading to an octant or a quadrant level, it's manipulation. That's what this is. That's what this is. Okay. Here we're using the middle of that little wick there, consequent encroachment here, back to the midpoint level, uses it perfectly there on that candle. Let me show you. See how that candlestick's high right here is riding along this level? See it? Isn't that pretty? That's pretty, isn't it? See how that gap stays there and didn't get worked at all? Why? Because it's the break through it, first presented after that on a trending day. That's the one you want to trade. That's the one you want to dogpile in on. We trade down to this octant, move lower to the next quadrant, lower 0.25%, back up to octant, trade down, work around that lower quadrant. Look at the bodies. Look at the bodies. What are they doing? What is this? What kind of artifact is that? This right here, this is proof. Proof unequivocally. This is absolute proof. There is no algorithm, bro. Look at this. The body's staying right there on that lower quadrant, on a range that didn't exist yet. Remember, these levels, as soon as you get the first hour's dealing range, you can project these levels and then watch how the day uses them. That's the stuff I write down on my notepad. As soon as I get the first hour's range, I'm writing that down. I'm seeing, okay, this is the level I'm anticipating. I'm looking at time and price. I'm looking at time and price. Looking at time, then price. Okay. So using this logic and then not getting down to the lowest low, couldn't get to it here, but we're in the last few minutes of trading. Using these types of things help me forecast. They help me weigh the strength or the weakness of a price run that I may be a part of or anticipating. And if I'm calling out levels, if I'm tweeting something like watch this level, watch that level, many times they are in agreement with these types of things and liquidity. So if there's a pool of liquidity that lines up with one of these levels using the first hour's dealing range. And again, don't, if you have something that works, don't say, oh, I have to have this, or I'm not going to be satisfied. If you have something already taught that's working, that's wonderful. Just include this as a side study, just to collect some data doing it. And I think it's an interesting thing to observe, and let your own experience using it determine whether or not there's any value to you blending it with your analysis. That's all I'm suggesting to you here. Okay. But the first hour's dealing range is very, very beneficial when you know what you're looking for. I.e., an example, how I was outlining this very thing here before it happened. And I told you, because we closed below this wicks, consequent encroachment, that sets the stage for lower prices in the PM session. That's what I told you in the live stream. That is not ambiguous. I told you I wasn't interested in doing here because I wanted to see what it does for the afternoon. And I gave the criteria that tells me that the afternoon was going to be bearish before the afternoon started.